When confidence moves faster than capital, money does not move first. Belief does. And by the time capital follows, the outcome is already forming. This matters today because modern markets are no longer driven by resources alone. They are driven by expectation. Confidence accelerates decisions before balance sheets change, before data confirms direction, before capital physically relocates. By the time money arrives, the landscape has already shifted. Understanding this sequence is essential because those who wait for capital to confirm what confidence has already decided are perpetually behind. To understand this dynamic, we have to separate value from conviction. Capital is heavy. It takes time to move. Confidence is light. It moves instantly. And in systems where reaction speed defines survival, belief becomes a leading indicator of reality. London learned this early. The city observed that markets often turn before fundamentals change. Prices adjust before earnings fall. Liquidity dries up before losses appear. Risk appetite collapses before danger becomes measurable. Confidence moves first, and capital scrambles to catch up. This observation transformed how London operated, because it meant that the most valuable intelligence was not financial data, but shifts in collective sentiment that preceded and often determined what the data would eventually show. This creates asymmetry. Those who sense confidence shifting early gain flexibility. Those who wait for confirmation lose it. At first, this seemed irrational. Markets reacting to mood rather than data felt unstable. But over time, it became clear that confidence was not noise. It was collective anticipation, a distributed judgment formed from countless small signals: tone, hesitation, alignment. Long before any official metric could capture them, confidence began behaving like gravity. It pulled decisions toward it. It shaped behavior without instruction. And once it shifted, resisting it became costly. Capital followed not because it wanted to, but because it had no alternative. And in a world where belief travels faster than money, the real contest is no longer about who has capital. It is about who sees confidence move first. Those who develop sensitivity to collective anticipation gain an advantage that no amount of capital can replicate, because by the time capital responds, the opportunity that confidence identified has already been priced, claimed, or closed. Confidence spreads through markets long before it becomes visible in numbers. It moves through conversation, hesitation, and tone, through what institutions choose not to pursue, through the opportunities that quietly go unanswered. London became attuned to these signals because it sits where anticipation converges. Traders, bankers, lawyers, and institutions sense shifts almost simultaneously. A deal delayed without explanation. A credit line quietly tightened. A risk committee suddenly cautious. None of these actions announce fear, yet together they signal it clearly. This is how confidence outruns capital. By the time data reflects caution, behavior has already changed. Capital allocation slows. Risk tolerance contracts. Liquidity becomes selective. Those waiting for confirmation arrive late to a reality that is already formed. This creates a powerful feedback loop. Confidence moves first. Behavior follows. Capital reacts. Markets begin pricing expectation rather than outcome. The future becomes present before it happens. This feels unstable, but it is not random. It is anticipatory. Participants are not predicting events. They are predicting each other. The market becomes a mirror reflecting collective belief back to itself, amplifying conviction in whichever direction it has already begun to move. London learned to read this anticipation carefully. The city watches for alignment rather than action. When many small decisions point in the same direction, confidence has shifted, even if no one admits it openly. Those who recognize this early adjust gently. They reduce exposure without panic. They preserve optionality without alarm. Others react abruptly when evidence finally appears. This is where inequality of outcome emerges, not from access to information, but from sensitivity to belief. Confidence does not announce itself loudly. It reveals itself through absence, restraint, and subtle withdrawal. And once capital begins chasing confidence, it is no longer leading. It is responding. The conflict appears when confidence detaches from reality. At first, anticipation protects the system. It allows markets to adjust gradually, absorbing risk before damage becomes visible. But when confidence moves too far ahead of fundamentals, it begins shaping outcomes rather than responding to them. Belief starts creating the very conditions it fears. London has seen this inversion repeatedly. Caution spreads, capital hesitates, liquidity thins, and suddenly, the slowdown confidence anticipated begins to materialize. Not because the threat was real, but because behavior made it real. The system reacts to its own expectation. This is where confidence becomes dangerous. When belief outruns evidence, it narrows options prematurely. Projects stall, investment pauses. Risk is avoided even where it is manageable. The future contracts because participants are already living in it. Markets stop asking what is happening and start assuming what will. Inside the city, this moment is watched carefully. The difference between foresight and self-fulfilling fear is thin. Adjusting too aggressively can trigger the outcome confidence predicted. Adjusting too slowly can leave institutions exposed when reality catches up. This tension defines modern market conflict. Confidence wants to move early. Capital wants confirmation. And reality sits somewhere in between. Those who misjudge this balance suffer quietly. They retreat too soon and miss recovery. Or they hold too long and absorb losses. The system punishes extremes. It rewards those who calibrate belief without letting it dominate behavior. But calibration requires discipline, because once confidence starts moving faster than capital, it tempts participants to treat expectation as fact. And when expectation becomes fact, markets lose their anchor. They begin drifting, not toward collapse, but toward fragility that looks stable until it suddenly isn't. The climax arrives when confidence finally meets resistance. Markets reach a point where belief can no longer move ahead of reality without consequence. Liquidity tightens too much. Opportunity disappears. Caution begins harming outcomes rather than protecting them. At this moment, confidence is forced to recalibrate. London understands this turning point well. When anticipation overshoots, the city responds quietly. Familiar processes resume. Selective commitments are made. Signals of continuity appear without announcement. Confidence is guided back toward proportion, not through reassurance, but through demonstration. This is the resolution of confidence outrunning capital. Belief slows. Behavior stabilizes. Capital finds its footing again. The system does not snap back instantly. It adjusts gradually, regaining balance through action rather than promise. Those who overreact and recalibrate painfully. Those who remain measured regain advantage. The future moves back into the distance, where it belongs. The lesson is subtle but critical. Confidence is a powerful tool, but it is a dangerous leader. Markets function best when belief informs behavior, not dictates it. When anticipation guides caution without replacing evidence. When confidence moves slightly ahead, but not so far that it disconnects entirely. London's role is not to eliminate this dynamic. It is to manage it. Because in a world where belief can outrun money, the greatest skill is knowing when to let confidence lead and when to pull it back. Sometimes the smallest shift in perspective becomes the beginning of a new future. When